Imagine giving an employee a $10,000 cash bonus.
Right. It's pretty straightforward.
Exactly. It's clean. You write a check, payroll handles the standard deductions, and the transaction is basically just over. But imagine giving that same employee a $10,000 stock option.
Oh, yeah. That is a completely different animal.
It really is. Suddenly, it's not just a bonus. It is a tripwire. That single piece of paper, it triggers a countdown clock with the IRS, it alerts federal regulators at the SEC, and it honestly sparks a jurisdictional turf war between completely different state governments.
It's basically the ultimate regulatory domino effect. I mean, you pull one lever thinking you're just rewarding a good employee, and this entire massive machinery of federal and state compliance starts turning in the background.
Well, welcome to today's deep dive into the source material. We have a very specific, explicit mission today. We're looking at excerpts from the National Center for Employee Ownership, focusing specifically on equity plan administration, federal securities laws, and state blue sky laws.
And since this is a dedicated exam preparation session for you, the listener, we are going to be distilling the absolute most crucial, highly testable knowledge from these chapters.
Yeah, we're getting right into the nuts and bolts.
Exactly. We want to break down the mechanics behind the rules so you don't just memorize them, you actually understand how they operate in the real world.
And to make sure this really operates as the ultimate study tool, we are going to do something a little different today. Periodically, we'll organically weave in a knowledge check right into the conversation.
Right. Just a chance for you to mentally pause, test your retention of the material we just covered, and really lock it in before we move forward.
So let's unpack the very first domino in this chain, which is building the foundational framework of an equity plan. Because obviously a company can't just wake up one morning and decide to hand out stock.
No, they absolutely cannot. Before a single share is granted, the company needs a structural blueprint, and the most common tool they use for this is called an omnibus plan.
Right. And looking at the setup for these plans, I was surprised to see that companies don't just, create a new distinct plan every single time. They want to issue a different flavor of equity.
Yeah, that would be an administrative nightmare. So an omnibus plan is essentially a massive umbrella. It allows the company to grant multiple types of equity.
Like ISOs and NSOs.
Exactly. Incentive stock options, non-qualified options, restricted stock, all from the same authorized pool of shares. It gives the board of directors the agility to adapt to the market.
So they don't have to keep going back to the shareholders for permission every single year.
Precisely. Maybe 1 year options are the best incentive, and the next year, restricted stock makes more sense. But the vital mechanism here, and a key point to remember for the exam, is that creating this umbrella requires formal approval from both the board of directors and the shareholders.
Okay, so you need consensus at the highest level to authorize that pool of shares.
Right. You absolutely need both.
Okay, let's unpack this a bit more. Once that plan is actually approved and running, the administration of it relies heavily on internal controls. And the text draws this really rigid distinction between policies and procedures.
Oh, yes. In normal conversation, people use those words interchangeably all the time, but in the context of equity compensation, they serve entirely different functions.
I mean, I definitely mix them up.
Most people do. But think of policies as the broad guiding principles. It's the what and the why. A policy dictates things like who is actually eligible for an award, or the methodology for determining the size of the grant.
And procedures.
Procedures are the unforgiving, step-by-step how. They are the rigid checklist for exactly how a grant is routed for internal approval, or the exact mechanical steps payroll must take to collect taxes.
So policies provide the framework, but procedures demand this strict, repeatable compliance.
Exactly.
And a huge part of that strict compliance revolves around exactly when these grants are made. Because timing is basically everything here.
It really is,
Yeah.
especially with public companies.
Right, because executives usually know when a massive piece of good news or, terrible news is about to hit the market, and regulators are constantly watching to ensure the company isn't manipulating the grant timing to enrich insiders.
Yeah, and there are two major red flags regulators look for here. They're called spring loading and bullet dodging. The mechanics of these practices are heavily, heavily scrutinized.
Let's start with spring loading.
So spring loading happens when a company deliberately schedules a stock option grant right before releasing incredibly positive news, like a massive earnings beat or a major FDA approval.
Because they know the stock is going to shoot up.
Exactly. The board knows the stock price is about to pop, so they lock in a low exercise price for the executives just days before that inevitable jump.
It's essentially like a company letting its executives buy a lottery ticket when the company already has the winning numbers sitting in a safe.
That's a great way to put it.
I mean, it completely defeats the purpose of an incentive because the executive didn't actually do any long-term work to earn that immediate price jump, and I assume bullet dodging is just the inverse of that mechanism.
It is. Bullet dodging is intentionally delaying the grant until right after the release of terrible news. Let's say the company just lost a major client.
Oh, so they wait for the bad news to hit the market.
Right, they let the stock price tank, and then they grant the options at that newly depressed rock-bottom price. Both of these practices draw intense scrutiny from the SEC and shareholders.
Which is exactly why companies need those strict procedures you mentioned earlier, right? Like dictating a fixed pre-announced schedule for option grants.
Exactly. It takes the discretion entirely out of the hands of management.
Speaking of shareholders, institutional investors have their own demands for executives. They don't just want executives getting stock, they want them holding on to it.
Yeah, they want them to have serious skin in the game.
Right. And proxy advisory firms, those influential groups that advise huge institutional shareholders on how to vote, they have very specific expectations. The biggest player here is Institutional Shareholder Services, or ISS.
Yes, ISS is highly influential. They generally enforce a standard where senior executives must maintain a minimum stock holding value equal to 3 times their base cash compensation.
Wait, 3 times? So if an executive's base salary is $500,000?
They need to be holding at least $1.5 million in company stock. But the crucial detail for the exam is what actually counts toward that threshold.
Right, because they can't just point to a massive pile of unexercised options and claim they're invested in the company, right?
Exactly. Unexercised stock options do not count toward the ISS holding guideline. They are viewed as way too speculative.
Okay, so what does count?
Well, unvested time-based restricted stock does count. ISS wants to see real, tangible exposure to the company's long-term performance. They want the executive to feel the pain if the stock drops and the benefit if it rises.
Basically mirroring the experience of the actual shareholders.
Exactly.
All right, since you, the listener, are going to be tested on this, let's lock this in. Time for our first knowledge check. If you're looking at a test question tomorrow, ask yourself right now, what is the fundamental difference between spring loading and bullet dodging? And what is the specific ISS standard for executive stock holding?
So focus on the timing of the news. Spring loading is locking in an option grant right before good news hits to capture the upcoming price bump. Bullet dodging is delaying the grant until right after bad news drops to get a lower exercise price.
An ISS standard.
The ISS standard expects senior executives to hold stock valued at a minimum of 3 times their base cash compensation.
Okay, awesome. So we've built the omnibus plan, we've set up the procedures, and we've made the grant. But creating wealth is only step 1.
Unfortunately, yes.
Because the moment you create wealth, the government wants its cut. And the mechanical differences between how different types of equity are taxed are staggering, especially the difference between incentive stock options, or ISOs, and non-qualified stock options, or NSOs.
Yeah, the tax code treats these completely differently. Let's look at the mechanics of an NSO first.
Okay.
When an employee decides to exercise an NSO, they pay the exercise price. The difference between that exercise price and the current fair market value of the stock is called the spread.
Right, the spread.
And under an NSO, that spread is immediately taxed as ordinary income. The company's payroll department has to step in, calculate the tax on that spread, and withhold it right then and there.
Wow, so it hits them immediately.
Immediate ordinary income tax. But because the employee is paying ordinary income tax, the company gets a corresponding corporate tax deduction for that exact same amount. And then later on, when the employee eventually sells those shares, any additional gain is taxed as capital gains.
Okay, so NSOs hit the employee with ordinary income tax at exercise, but the company gets a tax deduction. What is the mechanism for an ISO then?
ISOs are a highly specific tax-advantaged vehicle if the employee meets strict statutory holding periods.
Which are what exactly?
You have to hold the shares for more than 2 years from the original grant date and more than 1 year from the exercise date. If you do that, there is absolutely no regular ordinary income tax due at the time of exercise.
That is a massive benefit for the employee. I mean, they get the shares, and they don't have to write a check to the IRS that day.
Exactly. It's a huge cash flow advantage. They are only taxed when they eventually sell the shares down the road. And if they met those holding periods we talked about, that entire gain is taxed at the much lower long-term capital gains rate.
But there is a catch for the company, isn't there?
Oh, yes. Here is the mechanism you must understand for the test. The IRS doesn't give away revenue for free. The trade-off for the employee getting that sweet capital gains treatment is that the company gets zero corporate tax deduction. Ah, okay. That perfectly highlights why companies need omnibus plans. Sometimes the company wants the tax deduction, so they issue NSOs, and sometimes they want to give the employee the tax break, so they issue ISOs.
Exactly. It's a balancing act.
So let's move away from options for a second and look at restricted stock awards, or RSAs, because this brings us to one of the most notoriously unforgiving mechanisms in the entire tax code, the 83B election.
Oh, boy. Yes, this is a highly testable concept. So normally, if you are granted an RSA, you are taxed as those shares vest over time, right? Based on whatever the value of the stock is on that future vesting date.
Makes sense.
But Code Section 83B allows an employee to make a proactive choice. They can elect to be taxed upfront at the time of the initial grant based on the value of the shares today.
Wait, why on earth would someone volunteer to pay taxes before they even own the vested shares?
Well, you do it if you believe the stock price is going to absolutely skyrocket. By making the 83B election, you pay a small amount of ordinary income tax today when the value is low.
Yeah, and then all of that future explosive growth over the next several years is captured as capital gains rather than ordinary income.
Okay, so it's a strategic gamble. But the procedural deadline for making the selection is brutally strict, right?
It is entirely unforgiving. The signed 83B election form must be physically mailed to the IRS within exactly 30 days of the grant date, not a single day later.
Wow. 30 days exactly.
If you miss it by one day, the IRS rejects it, and you are stuck paying ordinary income tax on the higher value as the shares vest. Though there is one important procedural update to note for the exam.
What's that?
Since 2016, employees no longer need to attach a physical copy of this 83B form to their annual federal income tax return. It used to be a massive administrative headache that caused people to fail audits, but the IRS mercifully removed that requirement.
That is definitely good to know.
Yeah.
We also have to look at the mechanics of tax reporting based on who is actually receiving the equity. For a standard employee, all of this gets reported on a W-2, obviously. But companies grant equity to outside consultants and contractors all the time.
Yeah, quite frequently.
So how does that change the procedure?
Radically. Non-employees do not have taxes withheld by the company. Payroll does not touch their transaction at all. Instead, the company simply reports that equity income on a Form 1099 NEC.
1099 NAC.
Note the form name carefully for the test. The 1099 NEC actually replaced the old 1099 MISC for reporting non-employee compensation, and that started in the 2020 tax year.
Okay, let's do knowledge check number 2. Picture the exam scenario. A third-party consultant exercises a non-qualified stock option. Ask yourself right now, does the company withhold taxes on that spread? And what specific tax form does a consultant receive at the end of the year?
So the answer is no. You do not withhold any taxes because they are a non-employee. And that income is reported to them on a Form 1099 NEC.
Beautiful. So we've navigated the tax code and figured out how to pay the IRS, but the IRS is only looking for its cut of the money. There's an entirely different federal agency watching these exact same transactions, and they care entirely about market fairness and transparency.
Yes, the Securities and Exchange Commission, the SEC.
Exactly. Let's look at the 1934 Act, specifically Section 16, which is designed to keep company insiders in check.
Right. So Section 16A is fundamentally about daylight. Directors, executive officers, and anyone who owns more than 10% of the company's stock, they must publicly report their transactions. They use Forms 3, 4, and 5 for this.
And Form 4 is the big one here, right?
It's the workhorse. It reports any changes in ownership. And the SEC demands incredible speed here. A Form 4 must be filed electronically via ADGR within 2 business days of the transaction.
2 business days. And just to clarify the mechanism here, ADGR is the SEC's massive public database. When you file a Form 4 on ADGR, it means anyone with an internet connection, journalists, investors, competitors, they can instantly see that the CEO just dumped a huge block of shares.
Exactly.
2 days is an incredibly tight turnaround. But Section 16B is where the SEC goes beyond just asking for transparency and actually gets punitive. This is the short swing profit recapture rule.
Yes. Under Section 16B, if an insider buys and then sells, or sells and then buys company stock within a 6-month period, any profit they make on that trade is legally defined as a short swing profit.
And they get to keep it.
Absolutely not. They are legally required to disgorge, meaning pay back, every single penny of that profit directly to the company. The critical mechanism here is that this is a strict liability rule.
Meaning there are no excuses.
None. It does not matter if the executive actually possessed inside information. It does not matter if it was a complete accident. If the matching trades happen within 6 months, the profit is forfeit.
Okay, I want to push back on something here because the rules mention this concept of beneficial ownership. What if the executive isn't the one trading? Let's say you are the CEO, you know the rules, and you don't trade. But your spouse has a completely separate E-Trade account, and they decide to day trade the company's stock just for fun.
Yeah.
Can the executive be penalized for their spouse's hobby?
Absolutely they can. Under Section 16B, a spouse's trade in a completely separate account is generally matched with the executive's trades. Seriously.
Yeah. The SEC views the executive as the beneficial owner of those shares because they share a household and financial interest. So if your spouse sells 100 shares on Tuesday and you, the executive, receive a grant of shares 2 months later, the SEC will match those transactions.
Wow.
And if there's a profit, you are personally liable to pay it back to the company. It essentially stops executives from using their family members as proxy traders.
That is wild, but it makes complete sense when you understand the loophole they're trying to close.
And speaking of being forced to give money back, we have to talk about the clawback rules under Sarbanes-Oxley and Dodd-Frank.
Yes, specifically the relatively new 2022 NYSE and NASDAQ listing rules. Public companies are now mandated to maintain strict policies to claw back excess incentive compensation from executive officers if the company is forced to issue an accounting restatement due to material noncompliance.
And what's the look-back period on that?
The look-back period is 3 fiscal years.
And the most terrifying part of this for an executive is the regardless of fault standard, right?
Right. Exactly. Even if the executive acted with perfect integrity and the accounting error was made by, like, a mid-level manager 3 states away, if the executive's bonus or stock grant was tied to those artificially inflated financial numbers, they have to write a check and pay the excess back.
It forces executives to be hyper-vigilant about the accuracy of the entire corporate machine, not just their own behavior.
Precisely.
Now, at this point, you might be thinking, well, my company is a private startup. We aren't listed on the NYSE, so we don't have to worry about the SEC. Not so fast. The 1933 Act has rules that specifically target private companies, and the big one here is Rule 701.
Rule 701 is essentially the legal lifeblood of private company equity plans. Normally, anytime you offer stock, you have to register it with the SEC, which costs millions of dollars in legal and accounting fees.
Right.
Rule 701 provides private companies with an exemption from that registration process when they grant stock to their employees, but the exemption has strict limits.
And crossing those limits triggers a massive compliance headache.
Huge headache. For the exam, you need to know this specific financial threshold. If a private company sells more than $10 million worth of securities under this rule in any consecutive 12-month period, they cross the line.
$10 million in 12 months.
Yep. The moment they cross $10 million, they trigger heavy mandatory disclosure requirements.
What exactly do they have to disclose? Because private startups are notoriously secretive about their financials.
Oh, they have to open the books. Before any further sale of stock can happen, they must provide all the investors, which in this case means their own employees, with specific risk disclosures and formal financial statements.
I'm guessing they can't just hand over an internal Excel spreadsheet.
Definitely not. They must be fully compliant with GAAP or IFRS.
Meaning generally accepted accounting principles in the U.S. or international financial reporting standards globally. Standardized, audited financial rules so the employees can clearly read the true financial health of the company before buying the stock.
Precisely. It is a massive, expensive undertaking for a private company to open their books to that level of rigorous standard.
All right, let's pause. Here is Knowledge Check 3. Ask yourself, what is the strict filing deadline for Form 4 on the GR database? And what is the exact financial threshold under Rule 701 that forces a private company to hand over GAAP or IFRS financial statements to their employees?
So the Form 4 reporting a change in insider ownership must be filed within 2 business days of the transaction. And under Rule 701, exceeding $10 million in sales in a consecutive 12-month period triggers those mandatory financial disclosures.
Okay, great. So we've pleased the board of directors, we've carefully paid the IRS, and we've filed our forms with the SEC. We're in the clear, right?
Nope, not even close.
No, because complying with federal law is merely the baseline. Now you have to navigate the deeply fragmented, totally uncoordinated laws of individual states, famously known as blue sky laws.
It is an administrative nightmare. And you really have to wonder where a poetic name like Blue Sky comes from when we are talking about dense, punitive legal statutes.
It actually dates back to the early 1900s. A Supreme Court justice was describing fraudulent business promoters who would roll into a new state and sell shares in completely fake, non-existent companies.
Oh, wow.
Yeah, he said these predatory deals had no more basis than so many feet of blue sky. So individual states started creating blue sky laws to protect their own local residents from buying literal thin air.
That historical context is really helpful because it reminds us that while the SEC is worried about national market fairness, state blue sky laws are fundamentally about local consumer protection.
Right.
And for equity compensation, one of the most critical mechanisms to grasp for the exam is the two-security rule.
This rule is what causes payroll and compliance departments to just lose sleep. Because state regulators do not view a stock option as just one transaction. They view the option itself and the actual underlying stock as two completely separate securities.
Mechanically, this means a company can't just check a compliance box when they hire someone and grant them an option. The option is just the promise to buy stock later.
Okay, so they need an exemption for the promise.
Yes. The company must find a valid state legal exemption for the grant of that promise today. Then, perhaps 4 years later, when the employee finally decides to exercise the option and buy the shares, the company must find a completely separate legal exemption for the issuance of the actual product.
The stock itself.
Exactly. One state exemption rarely covers both events automatically. It literally doubles the compliance workload for a single employee grant.
And it gets infinitely messier when people cross state lines. Which brings us to the chaos of jurisdictional overlap. There is a fantastic hypothetical scenario from the text that you absolutely need to understand.
Yes, this is a classic exam setup.
Let's say Sample Corporation is officially headquartered in Washington State. Their vice president of sales works remotely out of an office in Nevada. That VP picks up the phone and calls a software engineer who lives in California, offering her a job and a massive grant of stock options to join the team.
Mechanically, this raises a massive logistical question for the company's legal team. In that Washington to Nevada to California scenario, which state's blue sky laws actually apply to the equity grant?
Let's make that our final test. Knowledge check 4. In that WA to NV to CA remote work scenario, which state's blue sky laws apply?
The answer is that multiple states can and routinely do claim jurisdictions simultaneously.
Wait, multiple?
Yes. Washington state could absolutely claim jurisdiction because the corporate authority for the offer effectively originated there at headquarters. But California will almost certainly claim jurisdiction because the offer was physically received there by a California resident and their consumer protection laws apply to her.
So the company has to comply with both?
Yes. The company has to comply with the blue sky laws of both states, finding exemptions in both jurisdictions for a single stock option grant.
So what does this all mean? It means you have successfully survived our exam prep deep dive. Let's quickly recap the incredible journey we just took through the regulatory machinery. We started with a foundation, understanding why companies use omnibus plans to avoid constant shareholder votes, and the vital difference between broad policies and strict procedures.
And we looked at how regulators absolutely hate spring loading and bullet dodging because it's basically rigging the lottery.
Then we navigated the IRS, contrasting the ordinary income tax of an NSO with the capital gains potential of an ISO, provided you meet those strict holding periods. We highlighted the brutal 30-day deadline for the 83B election and clarified that consultants get a 1099 NEC, not a W-2.
We survived the federal watchdogs at the SEC, too. Learning the rapid 2-day ADJRA deadline for Form 4s, the strict liability trap of short swing profits where you can be punished for your spouse's trades, and the $10 million threshold for private companies under Rule 701.
And finally, we wrestled with the overlapping state-by-state madness of blue sky laws and the two-security rule.
It is a phenomenal, almost dizzying amount of interlocking regulation for what starts as just a simple effort to reward an employee for their hard work.
It really is. And I want to leave you with one final provocative thought to mull over before your exam. Think about that final hypothetical, the Washington, Nevada, California scenario.
The remote work one.
Yeah, the laws were written when people lived and worked in the exact same zip code for 30 years.
Yeah.
But look at today's workforce. We have seen a massive, irreversible rise in remote and highly mobile workers. You could easily have an employee who lives in Texas when they are granted an option, moves to New York while it vests, and eventually exercises it while living in Florida.
Oh, the compliance tracking required for that single employee under the current system is just staggering.
Exactly. Given that reality, how long can this fragmented, geographic-based regulatory framework possibly survive? At what point does the blue sky system completely collapse under its own administrative weight, requiring total federal preemption so companies only have to answer to one set of rules?
It's something the industry is going to have to reckon with sooner rather than later. The nature of work is evolving exponentially faster than the local laws that govern it.
It's a tripwire, waiting to be tripped. Best of luck on your exam. You're going to absolutely crush it.